Hello, I've got a very special analysis today. I wanted to talk about geopolitical instability, how it affects the U.S. economy, and how it affects the markets. It's a very important subject that I want to make sure you have a clear understanding. So, let's go. So, first of all, understanding geopolitical instability. The first thing we got to do is define what we're talking about. Whoops, there we go. Geopolitical events refer to global political happenings that influence international relations and global economies, such as wars, standoffs, political events, etc. And the scope can be local, or it can be regional, or it can be international. So let's go look at some facts. Here is the first problem. There's a lot of emotional impact. When people make emotional decisions, they make poor decisions. And right now, we have the conflict in the Middle East between Israel and Palestine, and that has sparked emotional impacts all around the world. We see it in the U.S., we see it in the Middle East, we see it everywhere. That's hard to keep under control. It is difficult to maintain objectivity, but I want you to look at this. My job as an advisor, we've got to navigate personal and public emotions while at the same time providing clear, data-driven insights into these what can only be described as very complex situations. We've got to maintain objectivity. And in my opinion, here is the only way to do it. Go back, look through history, and see what actually happened. Not what I think or he thinks or someone speculates. History is the only thing that it is what it is. So let's take a look back here. So every time you see some of these, there's an immediate market reaction. And that immediate reaction to the news usually is a sell-off, is panic. Why? Uncertainty. We don't know what's going to happen. And we don't know what we don't know. So let's take those immediate examples and look at some historical data and see what happened after the first couple of days, our historical perspectives. We're going to go through in three phases. We're going to talk about actual case studies. We're going to list the market reactions. And then we're going to see what happened with people and the market. So, first of all, I'm going to go back to 1956, the Suez Canal. When that happened, it dropped the Dow about 3%, and the market recovered in months, in just a few months. 1967, the Six-Day War. Dow Jones again, about a 3% drop, and it took just a few months to fully recover. A major one, the Yom Kippur War. That led to the OPEC oil embargo, which was really the issue, not the war. And within a few months of the Yom Kippur War, the Arab oil embargo began, and that's what caused the issue with the U.S. economy, not the war. So let's dive into the OPEC oil embargo, 73, 74. The market dropped 14%. But here is the situation. Back in 73, 74, we got 40% of our oil from international sources, from OPEC. When that happened, we went into gas lines. You remember going every other day, depending on your license plate, to get gas. It brought the U.S. economy to a standstill. We went into a major recession, as oil is the number one ingredient that drives an economy. I don't care if you're a farmer with agriculture or you're a zookeeper running animals. You need energy to make everything work. So 73, 74, it wasn't the war, it was the oil embargo. And we're going to talk in a few minutes about the difference in 73, 74's energy situation compared to how we are today. And to use a very appropriate term, it's a whole new world. So, next war, the Gulf War, Bush's war, 90 to 91, caused about a 7% decline in the Dow. And the market recovered in just a few months. The Iraq War, we went into Iraq full force. Market had initially a 10% decline. And guess what? it fully recovered its losses within months. The biggest and longest decline was 9/11. After 9/11, the markets went down 14%. You may remember the market literally stayed closed for a week. We didn't open till the next Monday, and there was still panic selling. And that's the longest one it took to recover, and that took about a year to recover. And then just a more recent event, you look at the Afghan withdrawal, which many say was just a terrible way to exit the country. Initially, market went down, and it was very short-lived where the market recovered. And in every single case that I've gone through, not only did the market recover, it recovered and went on to new highs. Okay, those were military conflicts. What about a couple of economic events? You remember when Great Britain was leaving the European currency, European Common Union? There was a big to-do about what was going to happen. Would it break up the European central community? What would it do to Great Britain being separate? Market went down, but it recovered very quickly, and we're still dealing with it. But guess what? Great Britain still manages to do business with the rest of the world. And the U.S.-China trade war. When the Trump administration started to put on sanctions on China, again, there was a lot of, oh my God, what's going to happen? And guess what? We survived, our economy did well, and in that case, even China did well. So the initial panic and thoughts on all of these, guess what? They turned out to be wrong. So let's put it all together. You have short-term and intermediate reactions. Short-term, the market gets hit, and it gets hit because of uncertainty. There's panic. I don't know what's going to happen. Will it stay small? Will it go bigger? Uncertainty causes market weakness. Yet in every single case, you look at those case studies, guess what happened? The longest recovery was 9/11 and took a year. Overwhelmingly, within a few months, all of them recovered. And again, as I said a minute ago, all of them recovered and the market went on to new highs. Wow. So let's put all this in historical perspective. What's the biggest risk? The biggest risk is right after one of these, we have a recession. That was the 73-74 war. Well, how are we today? The U.S. labor market is very strong. Unemployment is strong. And I'm going to quote Janet Yellen, U.S. Secretary of the Treasury, quote, "You don't have a recession when you have 500,000 jobs and the lowest unemployment in 50 years. Now, these next two things are critical. The geopolitical dynamics in the Middle East are totally different than they were in 73, 74, and the primary reason is the United States, since 2018, has been the world's largest oil producer. Contrast that with 73, 74, 40% of our oil was imported. Today, we're a net exporter. We have the largest oil production in the world. It's the United States, then Saudi Arabia, then Russia, and then fourth, by the way, if Texas alone was a state, it would be the fourth largest oil producer in the world. If Texas were a country, excuse me, okay. And remember, we became the largest oil producer in 2018, and we remained the same through last year, 2022. So, look at a little historic perspective. We know that the Strategic Petroleum Reserve is not at full capacity, but our ability to produce oil is stronger than it has ever been. And as I mentioned earlier, Texas would rank fourth in the world if it were a country. It is a state, by the way. And the top 5 states in the U.S., Texas at 42%, New Mexico 13%, North Dakota, wait a minute, where did I get it right? Texas, New Mexico at 13, North Dakota at 8.9, I said 3.7, Colorado 3.7, and Alaska 3.7, and there's even more in Alaska if we can open up some more territories. But here is the key to all of that. Geopolitical events and dynamics in the Middle East today are totally different than they were in 73, 74. We are the world's leading producer of oil in the world. Okay, in our current economy, do I worry about a recession? Well, a couple of things. Number one, don't fight the Fed. The Fed's tightening circle has come to an end. Lower interest rates support stocks. The next move is more than likely to see the Fed start to lower rates. We've now had 2 sessions where it's been a pause. The Fed chairman has gone to a dovish talking points, and he reserves the right to raise rates. But all of the data that's coming in shows that inflation is slowing. The single largest ingredient in the consumer price index is housing. Housing, which is both buying a house as well as renting. House prices and rent has come down. If you look at commodities, whether it's wheat, whether it's coffee, whether it's corn, whether it's oil, all of them, lumber, they all have come down substantially since their highs of June of last year. So we're now looking at the consumption index is slower. We have a strong economy. The labor market is strong. And more important, the last item on here, disinflationary trends remain in effect. We're not going to go to the lower prices we had before all this, but the rate of inflation has slowed down. The Fed wants to get it to 2 to 3%. Depending on who you talk to now, it's somewhere between 3 to 4%. Our economy shows strength and it shows resilience. Wage growth is good. Economic growth remains good. Consumer spending remains strong. And even though we're above the 2% goal of the Fed, so much has worked positively. And as we said, the Fed chairman has hinted the Federal Reserve might be done in raising rates. And everybody knows this. If you go to fill up your car, it's a lot cheaper now than it was last year. So, with all this information, what do? Well, the first thing you do is realize this. You continue to have a long-term market outlook. When you look at all those examples, within months, with the exception of 9/11, took a year, the market recovered, and it went on to new highs. You can't time the market. So, maintain a long-term perspective. Case studies tell you to look at what happened, not what I think, what I fear, what someone says, what the TV says. Because remember, TV loves bad news. The economic channels like bad economic news, just like the weatherman likes a hurricane. It gets more people to watch. And then if you look at the economic implications, oil prices in the Middle East conflicts, they continue to lead to fluctuations, but over and over they have been resolved and moved forward. And the most important thing of all of this, our energy profile. The current United States energy profile is totally different than it was in 73, 74. So, strategies, what do? Stay diversified. If you're really concerned, we'll move some money into cash. It's not going to last long. Stay in quality stuffs. Keep a long-term focus. And here is the key to all of this. Behavior and emotions. Emotional decision-making is the worst decision-making in the world. When you panic, you make bad decisions. Anytime you see the market reactions, go back and look at history, see what's happened, and then try to make a rational, logical analysis and moves based on history, not based on the 5 o'clock news. So, to wrap it all up, we've looked through a historical analysis, and we've learned, I hope, Middle East military conflicts have little long-term effect. We need to balance economic history with the emotional fears. That is the key to navigating political instability. And like everything out there, it's important to maintain your discipline. When it goes against you short term, don't change your discipline. All right, I'd like to sum it up by saying this. It's easy for anyone to be there when everything is good. But one of the things we try to do is that when things don't look good, when things are tough, we're here as well. So remember this, those who fail to learn from history are doomed to repeat it. And those who learn from history can prosper. We add that perspective in that historical context. This is how we're managing things. If you would like to discuss your personal situation or talk about this, just give us a call. But I wanted to get this out to you so you could see a factual, historical analysis of what we're going through now and what's the most likely income and what's the best course of action for you to take. And as always, just remember, we're here looking out for you. Thanks again for watching.